for the 2024.
All right.
Perfect. And let's pave the way and let's cover the slides and what can be the pictures and the titles and the charts saying us and telling us about the story of the Africa and Asia. Let's focus on the emerging markets like the China today. And let's see, by the way, how can I close the screen? Because it is, yeah, now perfect. Now we are covering the China and the China sector earning and valuation. This is on the left-hand side. Please focus on this chart and the title. And it is saying that sector earning and valuation, the Chinese market. This is Morgan Stanley Chinese Market Index. This is the China earnings growth estimates for earning per share, year-over-year change. This is the percentage year-over-year change. And this is the consensus estimates. As you see here, we have lots of different sectors in China. And here, again, as you see, you will have the sector weights for the different sectors according to classification of MSCI sector indices. And here sector weights, this sector like the 28 and 22%, consumer discretionary and communication services, or let's say the financial market is 18%, or let's focus on the smallest one like the 2%, this is the real estate. And what is the problem here? The problem is this. Please focus on this MSCI earning growth estimate. What this picture telling us? Here, as you see, these are the estimate for 2024 and 2025. This gray and green bars showing the previous year and this year. And what is a dramatic change, especially in real estate sector? Because the sector earning growth estimate is approximately 50% for the Chinese real estate sector for 2024, 1 year ago. And now, this year, it's approximately dropping to approximately 8%, meaning that 40% droppage from the peak level of the real estate sector. But if we focus on, let's say, like the healthcare sector, in the 2024, it is just 8%. But then in 2025, earning growth will approximately converge to 39%. It's almost 40%. So if you have a holding in these different type of sector in Chinese market, and if you focus on the sector earning and valuation style, and if you're holding the real estate sector, please sell it. Okay, the picture telling us that in the 2024, just 1 year ago, the earning growth estimate is approximately 50%, but right now it's approximately just 8%. And then next year, if you are holding just the healthcare sector in the Chinese market in different sectors classification, then 8% is just earning growth estimate in healthcare. But right now, if you have those stocks in your investment and in your portfolio, then the next year your return will be approximately 39%. This is absolutely a high earning growth estimate. Dr. Walchin, I am closing my cam because it is, I think, decreasing the qualification of my internet connection. I'm speaking, but my camera will be closed. Then if we just changing the price earning ratio, the people who can attend my courses and what we are focusing on the valuation in different type of sectors, what is the earning estimate, what are the earning classification in those type of styles, we know the one of the best estimation methodology. It was the price earning ratio. The price earning ratio is one of the best methodology to evaluate the earning per share for the sector and showing us, telling the story about which sector is expensive and which sector is cheaper. So please focus on these bar charts and let's try to understand these charts as well. And they are saying that this price earning ratio in the Chinese market, this gray bar showing the 15-year range of the price earning ratio. And the blue one showing the current ratio, and the green one is the latest observation in the Chinese market classification. So if you have an opportunity to attain my courses in the previous session, and if you can make an adjustment in terms of your valuation methodology, what we know, if the average is higher than the current ratio, this sector is cheap. This is the basic methodology to understand which sector is good to make my investment. And let's just look at this healthcare sector. It is saying that 15 years average for the price earning ratio in healthcare sector is approximately 25. But the latest observation saying that it's approximately 20. What it is mean? My current ratio is less than the average. So this sector is cheap. Okay, 15 years price earning ratio is around 25 multiples, but today it is just 20. So it is cheap to take a position in this sector. But let's converge the screen. In Chinese sector is almost all of the companies and sectors is cheap. But if I want to change the methodology and different style of the picture, then I can basically adjust. Let's focus on the material indices. As you see, the material indices sector showing that the 15 years average is 11, 10, but the current ratio is approximately between 11 and 12. This meaning that the current ratio, the latest observation, is higher than the 15 years average. So this sector is expensive. If you have money today, don't take a position of Chinese material sector because it is expensive and most probably you will lose your lots of money in this sector. But if you put your money and investment methodology in consumer staples, consumer staple 15 years average is approximately 22, and the current latest observation is just 15. So you have approximately 7 times opportunity in terms of the price earning valuation methodology. You have opportunity to increase your investment in this sector because it is cheaper. But if you change the picture in the real estate sector, let's take a look at this one again. What is the picture saying us? It is saying that if you are putting your money in real estate sector, approximately during the 15 years, this blue bar showing 15 years average is approximately 8. But the current ratio, it is the green one, the current ratio is around 9. What does it mean? During 15 years, the price to earning ratio is 8, but now it is 9. It is higher than the average. So it is risky to take a position in this sector. I can lose lots of money in this sector. It is expensive. Okay, so according to price earning methodology, according to multiplication of those sector and methodological of perspective, you can directly understand that if you have the money in those sectors and if you can just adjust your portfolio according to price earning valuation, you should just focus on the average and the current numbers. The current ratio, if higher than the average, then this sector is expensive and don't take a position. And if those sectors current ratio is less than their average, this means that they are expensive, they are cheaper, sorry, then you can take a position and you can earn money in the long run in those type of sectors. Now, if we focus on the India, not the China, because we are in Asia and Africa side right now, let's take a look at the sector earnings and valuation in India. What is the picture telling us that? MSCI India earning growth estimates. Again, just take a look at the pictures. We have different sectors in India. And here we have the energy, utilities, technology, consumer staples, financials, consumer discretionary, healthcare sector, MSCI India index, and industrials, materials and communication services. What is the best methodology that we can directly say that? Here, as you see, the 2024 and 2025 is the estimates of the sector earning and valuation in India. Then The previous year, the 2024, is directly telling us that the price earning multiplication, these are the gray one, by the way. Okay, the gray bars showing us the 2024, the price earning growth estimates of the sector valuation in the India, according to Chinese and MSCI index. Then the green bar showing us the 2025 MSCI index valuation in India. These pictures saying that, let's take at the consumer discretionary, or let's take a look at the industry. It is saying that in industrial sector, 20% of the growth estimate will be approximately 22 in the 2025. So next year, approximately 2% of increase in the valuation and earning growth estimate of the Indian sector. Let's make the similar methodology in the sector again. What is the methodology here? It is saying that if we focus on the different sector in the India, and if I want to take the position, which sector is cheaper and which sector is expensive? As you see here, 15 years range in the gray bar is directly saying that this is, for instance, let's say for the communication services, from 0 to approximately 70% of the multiplication according to price earning estimate and valuation. This sector from 0 to 70, but the average is where? Average is just 15 for the communication services in India. But what is the current ratio today? It is approximately 40. What does it mean? During 15 years, the valuation is just 15, but now it is 40. What does it mean? It is expensive. Please, if you have money, don't take a position in India in the communication services sector. But if I change the position according to earning valuation and estimate, let's look at the financial market. It is saying that the financial market 15 years average is around just the 19, and the current ratio is 19 as well. What does it mean? The financial sector, according to valuation methodology, is fairly valued in India. So if I have the opportunity to take a position in different sector, for me, it can be the financial market and financial sector indices in India, because it can bring lots of opportunities and the session for me as well to take an investment and to take an opportunity for my investment and portfolio. Let's look at the biggest East Asian tiger who managed the technology world approximately from 1990s to 2010 during the 20 years. It is the Japan. The technology giant of the East Asia, the Japan, the sector earning and valuation is this. MSCI Japan earning growth estimate here. As you see in the utilities sector, it is saying that during 2024, the earning growth estimate is around 5%. And for the utilities sector, it will be approximately -10. So if you have money, please don't take a position because you will lose money. But if you are here in healthcare sector, in the 2024, you lose 5% of your money. But if you sufficiently patient in your portfolio in investment, your return will be 22% in the 2025. So if you are holding a portfolio in healthcare sector, please be patient. If you are in utilities, please sell all of it. If you are in financial, please sell all of it. But let's say if you are in material sector in Japan, please be patient. In 2024, you just earn 8%, but in 2025, your earning will be around approximately 18% during 1 year. So if you focus on the same methodology according to valuation and estimate of price earning and valuation methodology, what can be the opportunity in China if I focus on the price to book ratio? What can we understand from the price to book ratio? The price to book ratio telling us that you have value according to price adjustment in stock exchange. But you have a book value as well. Let's say you are producing some materials in a factory. Your factory, your machine, your persons, every equipment from the beginning till to the end of the production cycle. All of this have a book value. And if you sell those, you have a money. This is the book value of your company. But investors also make a valuation for your company and buying and selling your company in the stock exchange. It is the price. And price to book ratio showing us that how the investor perception changing according to price volatility in the stock exchange. So let's focus on the Japanese market. How can the price to book ratio changing the Japanese market? What is the methodology? If the price to book ratio is higher than the average, that sector is expensive. Please look at all of this, except the real estate and the utilities and the consumer staples. All sectors are expensive. Look at here. Current ratio is higher than the average. Look at here. Current is higher than average. Or look at here. Current is here 3 times higher than the average. So if you want to take a position in Japan, according to valuation methodology of the price to book ratio, then the fair value can come from the consumer staples, real estate, and the utilities. If you take the position in these 3 sectors, it can be good opportunity to earn more money in your investment during the 2025. But if you are in different type of sectors in Japan during the 2025, you can lose lots of money. And here, let's focus on how those type of performance of the drivers and earning and valuation methodology can change the price to book value, can change the earning valuation, and can change those type of style according to valuation methodology. If I have the opportunity in Europe, and please take a look at Europe relative valuation in the different sectors. What can this picture tell us about the investment technology, healthcare, industrial, consumer staples, materials, utilities, communication services, energy, financial and consumer discretionary? What these type of sector telling us according to average discount premium from 1990 and according to current dispersion of these sectors? As you know, the basic methodology of our sector valuation is telling us that we can directly check the 15 years average from these bars. As you see, these are the range from the peak and bottom line. Then what is the current ratio? Please look at the current ratio in industrial. It is almost in fair value. So you can take a position in healthcare or industrial. But let's focus on like the energy sector. As you see here, the 15 years range is here, but the current ratio is here. So it is absolutely discounted. It is 30% discount in communication sector or consumer discretionary, 50% discount in the consumer discretionary sector, meaning that this sector is absolutely cheaper when we compare to those sectors with the sector valuation methodology. And the buyback and dividend yield. You know the methodology of the buyback and dividend yield of those sectors as well. As you see here, United States, Europe, United Kingdom, and emerging market, buyback and dividend. Dividend is the payment at the end of the year according to net income and earnings of the sector. They are making a pullback operation and they are paying back to cash according to your investment in those sectors and companies. And these are dividend yield for you. And the net buyback. Buyback is how the companies support their sectors and buying back their portfolio and shares from the market. And as you see, lots of companies in Europe and the United Kingdom making lots of buyback operation, as you see here in the green bar. But in emerging market, the sectors and the companies does not support their sector and don't making sufficiently enough buyback program in their opportunities. And here, as you see, the emerging markets, these are the East Asia and Africa, the emerging markets, debt to the United States treasuries and return. These are the spreads, the 12-month forward and current ratio in basis point. These are showing the opportunities and the spreads of those companies in different emerging market. And what can this picture telling us? These are directly saying that if you have the opportunity and if you have two emerging market debt spread, when you compare to correlation between the United States treasuries and the return, as you see, it is almost zero. But in some companies, as you see here in the bottom line, current spread is between 240 or 250 basis points. These are the spreads. But what this picture is saying, this spreads can almost collecting around zero, but some markets, some countries diverging from the average, and they have lots of different spreads, approximately 900 basis points. These basis point showing us how your country is risky compared to United States treasuries and their returns. And here, as you see in emerging market real and nominal yields, we have Brazil, South Africa, Colombia, India, Indonesia, Mexico, Thailand, Poland, Malaysia, and China. As you see here, nominal and real yield. Lots of students here and lots of guests here knowing that what can be the difference between the nominal and real yield. If the nominal yield higher than the real yield, this means that or let's compare like this, if both nominal and real yield is positive, then the higher the inflation, the lower the real return you have in your company. So as you see here, you have huge nominal yield in South Africa, but the real yield is here. Or let's say in India, your nominal yield is here, but real yield is here. This is the exact conclusion or the result of the high inflation environment in these sectors. But if we focus on the Poland, for instance, nominal yield is 5% and the real yield is minus, meaning that inflation is higher than the 5%. For that reason, your nominal yield is 5%, your inflation is 6%, and your real yield is minus in Poland. The higher the inflation, the lower the real yield you have at the end of the story, according to valuation methodology. Here we have different asset classes, asset allocation. In here, lots of developed market growth, developed market value, US Treasury, US investment grade, US high yield. There are lots of asset allocation opportunities. But our main perception, according to asset allocation, we are allocating in three different styles: equities and fixed income. This is generally 60 and 40%. But if you want to make an categorization and different allocation according to the risk management perspective, the equities can be decreased 40%, fixed income can be decreased to 30%. Then this can be hybrid, cash, and lots of alternative investment, because you should hold some cash at your pocket. If the price going down, this can bring some opportunity to buy back your shares and decreasing your weighted average cost of those stocks and investments. So normally we are just directly saying that 40% and 30% is the basically the 40-60 is the basic well-known asset allocation methodology throughout the world. But today, if we focus on how we can distribute, it should be around 40-30 and the 30. So 30%, the others, or some prudential money in my pocket should be held to realize some opportunities if the price going down unexpectedly. Here, alternative source of income, as you see, equity, fixed income, and alternatives. The orange one are equity in this market, and the fixed income is the gray bar, and the alternatives is blue one. Here, as you see, the highest one is the fixed income in Asian high yield bond market. No risk, but it is high yield. Yes, there are some lots of risk in the high yield bond, because it is not just the direct government bonds. Sorry. It is the corporate sector earning. It is the corporate sector bond. There are risks behind those because they are high yield bond, but there are some lots of opportunities behind those screen as well. So if we are making a comparison, the highest one is coming from the Asian high yield bonds, but the lowest one, according to valuation, during the return, it is just the US equity, just 1.3%. It is really low, according to valuation methodology. Then, if we focus on the next slide, it is saying that understanding the alternative. What I say, normally, we have this asset allocation. This is the reference and the benchmark. 60% of stocks and 40% of bonds. But according to today's risk perception, you can decrease your volatility, because today we have lots of volatility in emerging market and the even developed market after the Trump election, because Trump threatening the world from different times to times. They are saying they will send the immigrants, they will put lots of tariffs in the international trade, and they will block lots of operation throughout the Russia and Ukraine and South Africa and the Middle East. So these are increasing the geopolitical crisis, and these are the increasing the risk perception and decreasing the risk appetite in the market. So as you see, if you decrease your stock and increase your bond, here please look at 60 stocks, here 40 stocks, here 40 bonds, here 60 bonds, meaning that if you put more bonds in your portfolio, your volatility is decreasing as your return is decreasing as well. But this is less risky. If you take higher stock position, like 70% and 30% bond, will do the higher volatility and higher return. So the main question should be this one. What is my risk perception? My risk perception, is it risk aversive? Am I risk loving, or am I the risk neutral person? If I'm risk loving, I will increase the stock in Asia and Africa, and I will decrease the bond. But if I don't like the risk and the lower return is enough for me, I will increase the bond and decrease the stock position. And the patience, the long-term return in asset classes. If I put just $100 in 1991, 30 years ago, $100. If I put this $100 in this 4 alternative way, this picture is important. Why? If I put this $100 in US equity, during 25 years, 30 years, it is now approximately 1,000, meaning 10 times higher. If you put $1 million, it will be $10 million today. If I put this money in United States high yield bonds, it will be 425, meaning 4 times higher. And dramatically, if I put this money, $100 in US short-term treasuries, during 30 years, I wait and I will lose the money at the end. So being patient is not enough. You should be selective in your position, in your sector, in your country. This does not mean that if you wait until the end of destiny, you will earn money. No, this is not true. If you are waiting in the wrong station, you will just lose your money. Okay? You should be selective in terms of the asset allocation and in terms of the risk perception. If you make this investment, please look at this one. You are putting just $100 in annualized return. And if you reinvest your return, your $100, it will be 16,000, meaning that 160 times high. This is huge money, ladies and gentlemen. 160 times higher. This is absolutely higher money, compounding effect. because you are getting dividend, and from that dividend you are buying another stock again, another stock again. You are not making investment, but with that dividend yield, you are making another investment. And your money will be approximately, if you put $1 million during this year, 50 years, your money will, your $1 million will be $160 million. Okay, this is important. And now, portfolio construction and asset classes return. Please look at this one. If you are conservative, you are here. If you are balanced, you are here. If you are aggressive, as I said, higher bond, higher stock, higher volatility, higher return. But if you are conservative, higher bond, lower stock. Your first question is this: am I conservative, meaning that am I risk aversive, or am I risk neutral, or am I balanced, or am I aggressive, meaning that am I low in the risk? Then you will start to take a position in stock exchange, bond market, or high yield bonds. And as you see here in the last slide, you will see lots of different dates. And here we will cover the slides and the opportunities of the different collapse and different recession period. These gray bar are the recessionary period in American history. This is the VIX. This is Chicago bond option rate. Okay, this is the fear index in the world. If the VIX is increasing, there are lots of risk. And here, as you see, this is the COVID-19 risk and the recession. This is 2008 global financial crisis. This is the internet.com crisis in 2001, and here the gold crisis in the United States and the Middle East.